All right, gang, we'll give it a couple minutes for people to trickle in. It's funny because it's the Wild West end of it.
Yes, I saw DJ.
All right. So, hey, everybody, this is our first webinar here at New Lab, which is going to be on the climate tech capital stack. A little bit about New Lab. We consider ourselves a global venture platform focused on accelerating commercialization and go-to-market for critical technology startups. We have a bunch of different hubs, different locations focused on things like advanced manufacturing, mobility, ocean tech, carbon management, critical minerals. Keep expanding, keep growing. Our goal is to help unlock access to infrastructure assets, piloting opportunities with corporations, as well as non-dilutive and dilutive capital. These are just some numbers to throw in front of you. I think that the big exciting thing that we really focus on is our pilot deployment, which is why we're talking about the Climate Tech's capital stack today. So I'm joined by Lisa, Campbell, and Gabriel, who are going to be talking about a bunch of different things, and we're really excited to get going and introduce them. So when we're talking about the Climate Tech capital stack, I think what's really important to understand is that this is, another iteration of Clean Tech 1.0 and the boom and bust that happened back then. And ultimately, the VC model isn't always best for a lot of different startups. And the iteration that we see now, as opposed to Clean Tech 1.0, is a lot of different actors crowding in to help support these different startups. There's a lot more work to be done, which we'll talk about as well. But I think one of the best publications that I've read is this publication here by Ben Gaddy as well as Frank O'Sullivan. Ben Gaddy's at Breakthrough Energy Fellows now, and Frank is over at S2G Ventures. And it's a pretty fundamental read on, lessons learned from the Climate Tech 1.0 boom and bust. So highly recommend that. And this is kind of what we're talking about today. What we see is there's a big tranche of funding and a missing middle in terms of like the capital stack, that as we start to see what happened in 2021 and 22 with a lot of different startups raising capital in climate tech, the next step in the big hurdle is getting to that bankability and that first of kind. So I'm going to hand it over to Lisa to get us going, and I'm going to stop sharing my screen.
Thanks, Alex. All right, let's see if I can, in fact, share my screen. All right. Can you guys see the screen? Great. So great to meet all of you guys. And Alex, thanks so much for that excellent lay of the land. By way of introduction, I'm Lisa Hansman. I'm a principal at Engine Ventures. The Engine is a venture capital fund that invests in tough tech companies with the goal of translating breakthroughs in science and engineering from the research context into the commercial sector. And I like to use this slide because before I started working at the Engine, I worked at the White House, where I focused on implementing the administration's industrial strategy for the clean energy economy. And so I've spent the past couple of years thinking about how we collectively, as the United States, deploy private investment to our productive capacity and the technologies that are going to define the markets of the future. But I spent a little bit of time at MIT where we worked on a tool to measure whether, in fact, those public incentives were actually crowding in private investment into the clean energy economy. And this graph is an output of that work. And I think it shows relatively clearly that on a macro level, the clean energy economy is booming. The past 2 years represent a 70% increase relative to the 2 years prior in terms of funding in the clean energy space. But once you start peeling back the onion, as Alex did, I think what you start to see is that critical gaps remain, especially for scaling novel emerging climate tech innovations. And so I joined the engine to take a more direct approach to filling those gaps. And I'm hoping that today we can do a couple things. Talk about why it is that the kind of capital that you bring in matters. Talk about what we mean when we say the climate capital stack, which was such a strange and wonky phrase to me the first time I heard it, and what sources of capital are actually available when and how that's changing. And then third, and I think most importantly, talk about how it is that you set yourself up to attract the lowest cost of capital that you need to scale as quickly as possible. And so just at a very fundamental level, I find it helpful to ground ourselves in why the role of capital actually matters for clean tech companies. And at the most basic, all organizations are really an amalgamation of three things: teams, so people who build things; technologies, the things that they build; and then capital, which enables you to hire more people to build bigger and better things. But in the context of clean tech, I think something that the engine has done a lot of work on is recognizing that tough tech companies, so companies like you in sectors like climate tech, often needed more capital and longer timelines in particular to translate from the research context into the market setting. And that's because of the realities of what it takes to build hardware in the real world, right? You've got long supply chains, costly and unpredictable feedstocks, complicated engineering, the need for large factory and land-based assets to actually deploy the technology in the real world. And what that translates to is that the capital intensity of clean tech means that the cost of your capital has an outsized role on your unit economics and consequently your ability to commercialize. So if you look at this graph on the right-hand side, it shows the impact of capital costs on the levelized cost of electricity for renewables projects. And what I found pretty shocking the first time I saw this was that even at an 8% cost of capital, which is relatively low and certainly very low in the climate tech space, capital costs comprise 50% of the levelized cost of electricity. So from an end user standpoint, this is incredibly important. And so your goal, should you choose to accept it, is to attract the cheapest possible capital as quickly as you can so that you can, in fact, drive down your own costs. And so as a starting point, this is a very basic map of, let's call it, the climate capital stack. There's lots of ways you can slice and dice it, but I think the core point is that not all capital is created equal, and capital comes at different costs based on the risk appetite and the return expectations of the investor. And so working our way basically top down, I think you can think of this roughly as going in order of most dilutive to least dilutive capital with some nuances along the way. Venture capital, the first layer of the capital stack, the layer that you all are probably most familiar with, will take significant risks because of the uncapped upside that equity offers them, but will charge a cost, and the check sizes are relatively small. So good for early stage, but a challenging source of capital for scaling. Then moving one click down, growth equity and private equity will typically come into play at the Series B and C stage. You've got lower hurdle rates, larger check sizes. You're still investing in the company specifically. And here, I think Elemental has done incredible work on actually mapping out the supply gaps in this kind of layer of the cake. This is really the capital where we, I think, see the biggest trough. And I think you guys, Gabe, you'll talk more about this, I would imagine, size it at roughly $150 billion gap in terms of supply. So we're really supply constrained when it comes to that kind of scaling flavored equity. And then going one layer deeper to infrastructure and project finance, the nuance here is that investors at this stage offer a significantly lower cost of capital, but are investing in projects or assets rather than at the top co, that is, rather than providing equity in the corporation itself. And these are places like Blackstone, Stonepeak, Brookfield that are writing checks from huge $10 billion, $20 billion funds that have experience in deploying massive infrastructure projects like nationwide gas pipelines and the like. And they are trading that uncapped upside of equity investments for the reliability of cash flows or tax credits from an underlying project itself. And what that means is that they can't take binary risk in the way that venture funds can. They can't risk a zero on their balance sheet, and they're much, much, much more conservative. So while the supply is there, the sources to which it can be deployed are substantially limited by what meets the risk thresholds of infrastructure and project finance providers. Same thing for commercial debt, which is typical bank debt. This is the most de-risked debt. And then we've, of course, got government grants and loans. I will not spend much time on this because Campbell is much more eloquent on it than I am, so I'll let her talk about it. But I do want to spend a minute on tax credits because to me, this is the unsung innovation of the Inflation Reduction Act, which is the IRA made it much, much easier to monetize tax credits by enabling the transfer of tax credits. So it used to be that you could only really use a tax credit if you yourself had liability to absorb the tax credit. Now there's a market in which you can transfer tax credits and sell it to, say, a large corporation with significant tax liability and monetize that tax credit by getting, at some discount, the value of the credit upfront. But here, your counterparty's risk tolerance is what matters, and you're selling to a large corporate provider typically who wants a guarantee that the widget that you're going to produce to receive that tax credit off of is actually going to be made, or the factory that you're getting an investment tax credit for is actually going to be built. So basically, to be cost competitive and profitable at scale, you want to move from the red to the green on the cost and check size. So you want lower costs, bigger check sizes, but that requires retiring risk. And so how does that actually map up to what the climate tech deployment journey looks like? I think this graph I like because you don't actually have to look at the words to figure out the issue. It's a barbell, right? On the left, you can see that where tech risk is lower, capital is relatively plentiful. You've got lots of VC check money available, even if there's some seasonal nuances here, but writ large, there are checks available for you to basically test the feasibility of your core technological innovations. Go all the way to the right-hand side of this, where there's lots of capital available for you once you've driven your tech risk all the way down and you've demonstrated that you can, in fact, produce the widgets that earn the tax credits that tax equity is looking for and that project financiers can monetize, and that you're operating with no technological risk. But there's this issue in the early deployment phase when you're building a first-of-a-kind commercial plant or project, when you're seeking a often multi-$100 million investment to build out a facility that takes your technology and scales it up, but really is about actually proving out your unit economics and your go-to-market and commercial traction. And as we saw, the supply of capital that is of that scale sits right now at the infrastructure and project finance stage. And I think fundamentally the challenge here is that there is a risk-return mismatch between where most climate tech companies are at in that early deployment stage and what it is that infrastructure and project finance investors look to. And I think in understanding this nuance, it's helpful to map out what it is that you as entrepreneur are looking to de-risk so that you can be in a position to pull in that later stage capital. And so on the company side, when you are approaching the commercial stage, you may be dealing with 4 interrelated risks. There's the question of what happens to your technology as you scale it up. Does it still work as you think? This is ideally one that you've already taken off the table, I should say. There's the operations and engineering risk, which is when you integrate that technology with stuff that we already know works very well generally, do those 2 elements work together in the context of a factory or a project? Then there's the question of, are you going to see the cost declines that you modeled out in your techno-economic analysis? Is Wright's law going to deliver? The more you manufacture, the lower your costs will go. And then there's the question relatedly of what price are you actually going to be able to secure, often in markets that you're creating from scratch where there's no benchmark for you to compare against, or the benchmark is one that's constantly fluctuating based on commodity prices. And so because of this, the reality is, if we are ruthlessly honest with ourselves, early stage commercial deployments are unlikely to generate significant appealing returns in and of themselves, which is challenging because infrastructure and project finance looks at the project level typically for returns. And so you will generate returns down the line, but not today. And so you need to bump up against what it is that an infrastructure investor is looking for. And here they have a checklist of requirements, from project level IRRs to significant hours of performance logged to clarity around those unit economics, to, most importantly, I think, some sense of security around the offtake that you're likely to be able to secure, and ultimately a performance guarantee that accounts for the inherent risks and all of those things that we just talked about. And that's a challenging checklist to meet. And so your challenge is to develop a path to scale that demonstrates that you meet each of these criteria by retiring the risks on the left-hand side in some phased manner. Now, you're not doing this entirely alone, because while we looked at that kind of version 1.0 of the climate capital stack, we're seeing just as much innovation, I would say, on the financing side as we are on the underlying technology side, which is really exciting. But it's very much a fluid landscape, and that's one that you have, I think, an active role in shaping and needing to pull together different elements. So what I mapped out here is a range of kind of interesting partnerships that I think exhibit some of the models that are emerging. But rather than running through all of these, maybe I'll just give an example or two that I think illustrates kind of the creative approach. So if you take Infinium, they're developing their first of a kind power to liquids e-fuels facility, which is going to be the largest of its kind in North America. They blended catalytic capital, so a 75 million equity commitment from Breakthrough Catalyst, with a long-term offtake from American Airlines, with a commitment to sell their carbon credits that they're generating through the production of carbon neutral SAF to Citibank, which then gives them some buffer against unit economics risk because they have an additional stream of revenue. And that's a really creative and interesting manner of braiding together several different sources of capital to acknowledge the fact that it's quite difficult to simply finance in an off-balance sheet manner a huge first-of-a-kind facility. And I think the Google Fervo NV Energy amalgam is another interesting one here, where it represents how, if you can align the strategic interests of multiple players, there's actually a lot more flexibility in the capital stack than we think. So take Google. Google is under a lot of fire for the carbon intensity of its data centers, very incentivized to find clean electricity, and has about as close to unlimited willingness to pay as you see out there these days. Meanwhile, Nevada is very concerned about electricity costs for its broader customer ratepayer community. Fervo needs a guaranteed source of offtake to scale up its geothermal operations. So Google committed to a power purchase agreement structured through the Nevada utility that isolated the costs of geothermal from broader ratepayer impacts and provided Fervo with a guaranteed source of offtake. So lots of creative work going on here, but one that really does require active structuring, I think, on the part of entrepreneurs, which is part of the fun of this as well. And so want to just take a quick minute to talk about what it is that you can do as clean tech entrepreneur to actually start laying some stepping stones over this missing middle in the climate tech scale up journey. And I will say that from the early investor perspective, I think a lot of people say early investors don't care about this stuff, but actually our interests are quite aligned, because if an early stage company is in fact unable to secure non-dilutive financing, we get diluted out too. And worse, if an early stage company is unable to attract any follow-on funding, then we ourselves fall off that cliff into the valley of death as well. So these are criteria that, even though our risk profile is different, we need to be looking at from the lens of later stage investors as well. And Alex, I think to your point on Climate Tech 1.0, that's a lesson that the VC community has very much internalized at this stage. And so I would say step one is actually facing the challenge and being super realistic about the capital intensity of what your scale up journey will be, how much capital you will need to raise, and then mapping out, working backwards, a series of development milestones that enable you to retire risks and run experiments that retire those risks at the lowest possible cost in a staged manner. So do not write a scale up plan that has you going from a benchtop demo to a debt funded first of a kind commercial plan, because it underscores the risks about your ability to enable those kinds of creative structures that are so important in unlocking capital here. And then use it as an opportunity to engage with those later stage capital providers earlier on. Have them pressure test with you your milestones and what it is that they would need to see to come in at stage X or stage Y. And then you're able to actually tap into that network when in fact you have retired risks. And then I think critically important is building your team to be able to execute on projects from day one. And this is a very early indicator of project readiness, frankly. So the skills needed to execute projects are really gnarly. You've got to navigate permitting and zoning. You've got to think about the operations integration, labor management, you name it. And so you want to instill confidence that you are building your product or your project with deployment in mind from the very first moment. And these skill sets exist. They're in EPCs, they're in at the front lines of scaled industries like mining, like oil and gas, and tapping into those early, making those connections early is critically important. And then as you are building, think about building modularly such that you can go to the infrastructure investor and say, hey, yes, I haven't deployed a plant at, gigaton scale, but there is actually no fundamental difference between that process and my process right now because all I'm doing is stacking blocks. Now, obviously, that's not a solution that's available for everyone, but the extent to which you can design your smaller experiments to look identical to your later stage deployment is incredibly helpful in terms of retiring risk. And finally, I think about how you can create some of those innovative partnership structures that tap into the strategic needs of your off-takers as well, a la American Airlines, a la Google, where you can't meet requirements and try and shape new structures. And I think another new flavor of financing that we're likely to see is modifying the project finance kind of template to build in structures that enable those investors to tap into the upside that they generate by helping to drive down project costs. So for instance, thinking about compensating investors with warrants or giving them rights of first refusal to follow on projects where unit economics are improved. And so I'm going to turn it over to the rest of these folks to talk about different flavors and sources of capital that exist, but always happy to be a resource and really excited to see what you all build.
Awesome. Lisa, that was fabulous. Thank you so much. I guess question for you is, I think both of us, all of us here, we work with a lot of like very, very technical scientist founders. What is like one big piece of advice or like words of wisdom that you could offer to them as they're like starting to consider spinning out of academia?
I think talking to folks who have made that same transition is the best thing you can do. It's very trite, but seeing it gives you the opportunity to see yourself in 5 years' time. And time travel is rare, so that's pretty powerful. And we are happy to provide resources after the fact on a set of who those folks are, if it's useful in different fields.
Awesome. Thank you so much. Yeah, we'll be sharing some resources and follow-up for the people that registered for the webinar. Campbell, over to you.
Awesome. Thanks, Alex. Thanks, Lisa, for teeing that up. Give me just a minute here to share my screen. All right. Can folks see this? All right, I'm seeing a nod. Fantastic. All right. Well, hi, everybody. Thanks so much for taking the time out of your busy day to discuss how we can, build out this climate capital stack. Lisa did a fantastic job just now describing it. Huge thanks to Alex and to New Lab for putting this webinar together. By way of introduction, my name is Campbell Howe. I'm a senior strategy advisor within the Loan Programs Office at DOE. I've got about 10 or 15 minutes here. And so what I'm going to do is share first, how DOE is supporting climate tech companies, throughout the climate capital stack, or sort of across this RD, D and D continuum, lots of letters there. I'll get into it. Second, I'll talk a little bit about what is LPO and the role that we play on this continuum or within this capital stack. Then I'll speak a little bit to our pathways to commercial liftoff effort, shortened to liftoff. And then finally, I'll wrap with a few ways to engage with DOE and with LPO, which I think Alex will share around at the end. All right. I do apologize. I'm aware that this is a somewhat pixelated image, but bear with me. I think that this is a helpful reference for how different offices really across the Department of Energy can support climate tech companies, startups, really sort of throughout the entirety of the project life cycle and company life cycle, from early stages of basic and applied research through development into larger scale demonstrations, and then ultimately true full scale commercial deployment. I believe many folks on this on this call are sort of on the earlier stage side of things. So earlier stage founders and funders. So hopefully you all are familiar with Department of Energy's 17 national labs, with ARPA-E, with SBIR, and with our different programmatic offices that would apply to your individual technologies. So if you're in the hydrogen space, you should certainly be looking at the Hydrogen Fuel Cell and Technologies Office. If you're thinking about sustainable aviation fuel, you should be looking at the Bioenergy Technologies Office, and the list really goes on. What these organizations are really doing is leading and supporting research and development, again, for these earlier stage projects and for these more nascent technologies. And their work is helping answer the question, will this technology work? Then as startups are moving beyond the prototype and into pilots and maybe even early demonstrations, you might start to see some market pull, right? Some positive signal. I think Lisa really spoke very eloquently to thinking about commercialization early, and finding the right off-takers, finding the right strategic capital and the strategic partners there. And so once you're at that stage, you're most likely going to be engaging with the Office of Clean Energy Demonstrations, very aptly named. You'll be in the demonstration phase. And these folks are helping to provide supportive and non-dilutive equity, normally at a 50% kind of cost share basis. And so that's sort of much more similar with a growth equity kind of model. And really what OSET is trying to do is answer that question, hey, this technology works, but will it work at scale? And so once a startup is, successfully demonstrating the technology at scale, you're probably ready for a full scale commercial deployment. And that's where LPO sits in. So we're sort of answering the question, the technology works at scale, but do the economics work? So the questions we'll kind of, pose will be, does this start a new market? Is, catalyzing a market? Is it expanding or scaling up an existing market? All right, so that gets me to talking a little bit about what is LPO. So LPO, or the Loan Programs Office, we don't provide equity and grants the way some of our sister offices do, but instead we're providing loans and loan guarantees to high impact and large scale energy infrastructure projects across the country. When I mean large scale, I mean truly large scale. We work with projects that are, larger than $100 million, typically closer to $1 billion actually. And these projects are typically at a TRL of 7 or higher, or sort of typically in like kind of an 8 to 9 range. And so the tech is fairly mature, but there's an element of innovation normally associated with some of these projects. So there's some element of commercial or market risk that has not yet been fully tamped down, and so that's why a traditional commercial bank may not necessarily be willing to back it. And so there's a gap here where there's the project wants to hit sort of true commercial scale. They might have offtake, or they do have offtake, and they've tamped down sort of their market and technical risk, they've tamped down their project and technical risk, but less so the market side. So we want to go in as LPO and we'll finance that first project, the first of a kind folk project. We're providing extremely favorable terms to the project developer, but we do, again, as a loan or loan guarantor, lender or loan guarantor, we do have a reasonable expectation of repayment, right? And so the idea is we go ahead and we finance that first project. There's tremendous success with it. And then a traditional commercial bank will say, okay, we're going to come in now and we're going to finance the second, third, fourth, up to an nth of a kind of that same project. So in other words, that's when a project becomes bankable. Lisa did a great job sort of articulating the infra investor checklist, which in many ways is a checklist for how a project can be defined or described as being bankable. But if I had to articulate sort of that nth stage, sort of what is a fully bankable project, I would define it in terms of a project that's at a TRL of 9. The performance has been proven at scale with thousands of hours of operational time. That project has credit-worthy off-takers with long-term, fixed price offtake. They have a very high debt to equity ratio, north of 70% debt to equity. Experienced project managers with a fully wrapped EPC contract, and also a project with a robust community benefits plan, right? And a deep bench of talent, sort of not just across the engineering side of the house, but also thinking about sales, thinking about finance. So truly a mature company or a mature project. Okay, so moving on, what kinds of technology does LPO look at? Our loans historically have really helped catalyze utility scale solar and wind industries here in the United States. And we've helped expand up domestic electric vehicle manufacturing. We've been reviving the nuclear energy industry, as folks might see from from recent announcements. And as a result, a lot of private sector capital has really followed our loans, right? And so I think there's a stat out there that says about 90% of clean tech or climate tech finance is really going now towards these more mature sectors: solar, wind, EVs, heat pumps, long duration storage. So it's our goal to rinse and repeat this model with more nascent technologies. So we're spending time in clean hydrogen, in biofuels, in critical materials, grid technologies. This slide here is going to speak to, a few of our success stories across different sectors. I think many folks on this call are aware, but LPO went in and financed Tesla's first Model S factory. We've been able to issue conditional commitments to VC-backed companies like Redwood Materials that are, in the EV material space, and the list really goes on. And happy to share more on these later. But perhaps it's helpful to show a pretty recent snapshot about some of the momentum that's happening in this office, which is we have about 209 active applications as of last month, and they represent almost $300 billion worth of requested loan amount. And this year, I think we're expected to be putting out about $30 billion of debt commitments. So we're staying extremely active in the space, and it's really encouraging, I would argue, to see how many projects, how many technologies are getting to this stage in our continuum or across this capital stack and getting to this level of maturity. All right. So again, I think most people on this call are early stage founders and funders. And so, maybe you're asking, all right, nice to see everything LPO is doing, but how do we get there? We're still in the earlier stage of things. So I wanted to just scale back for a minute and take a look at our continuum one more time, and say that DOE, continues to work to get, companies and to get technologies really across the finish line, crossing that bridge to bankability. And one of the most cross-cutting initiatives that DOE is leading is our Pathways to Commercial Liftoff report, which I mentioned at the top of this call. So if you haven't come across it, I encourage everyone to go and visit liftoff.energy.gov after this webinar and check out some of the work that we've been leading. But this is truly a cross DOE initiative. And so it's pulling the learnings and the research from our national labs and from our programmatic offices and combining that with the commercial learnings from our DOE investments across LPO and across OSED and across our other offices. And taking all that DOE knowledge with the combined, power that is, hundreds and hundreds of stakeholder interviews with folks from startup founders to subject matter experts and chemical and electric engineers, community organizers, state and local elected leaders, and other federal agencies, customers, off-takers, investors ranging from early stage VCs all the way through to commercial banks, nonprofits as well. Of course, they have a huge role to play in this capital stack as well, to really provide a common fact base, if you will, with the state of play of a clean energy technology and the how and when it will reach commercial viability, right? Commercial viability or commercial liftoff is what we're calling it. And that sort of timeline and those steps will hopefully help align and catalyze action, both, amongst entrepreneurs and operators, but also amongst investors or really across the capital stack. So these culminate into, we have 11 reports published to date and counting, more to come for sure. And these topics range from everything from advanced nuclear through to low carbon cement, offshore wind, virtual power plants, and advanced grid technologies. And, we don't only, report these, share out these reports and sort of leave them there. We continue to iterate on them, and we want to make sure that these are living documents. So you'll see updates to some of the reports that got published a year ago to ensure that we have the most up-to-date information on the ground. And then we communicate it back, to you all, to industry through conferences, through webinars like these, convenings like New York Climate Week, which I know is coming up. And the idea is that we really want to ensure that these are iterative and representative of the full industry. Great. I know that I'm probably at time here, so I'll just wrap by saying, DOE is really meant to be a partner to you all and to the important work that you're doing. Jigger Shaw, who's our director at Loan Programs Office, always says that this energy transformation is private sector led, but government enabled. So, if you have questions or comments, please don't hesitate to reach out to me. If you lift off specific questions, the email is there. For funding opportunities, whether it's grants, awards, if you want to learn a little bit more about LPO, please go and visit energy.gov. There's some great resources available there. And then last but not least, this is a plug for a conference that DOE is hosting in December in Washington, D.C. It's called Demonstrate, Deploy, Decarbonize, or Deploy 24 for short. And it's really focused in on, again, how do we align and catalyze the industry to help us reach our decarbonization goals more quickly, more effectively, and really take use of this robust capital stack. So thanks, everyone. Really appreciate it. And I think, Gabe, it's over to you.
Thanks, Campbell. Before we head to Gabe, question for you. Also, shout out to the DOE for all of the work that you guys do. It's just incredible to have such an active governmental agency supporting the climate tech community. Also, thanks to OTT for sponsoring this webinar. Question for you before we head to Gabriel. What is your biggest piece of advice for startups at like pilot and demonstration scale as they start to think about bankability? And what are some of the biggest gaps in preparedness that you see for startups that are coming to you?
Yeah, happy to. And definitely OTT actually is sort of the lead on our liftoff effort. I should have called that out earlier. So they're wonderful. And we work very closely with the OTT office. So that's great. I would say Lisa did a wonderful job articulating a lot of them. So, I think she spent some time talking about creative offtake and thinking about commercialization potential early and focusing on unit economics. So those are critically important. And I would probably say those. But since those were already addressed, two more, I would say, one is probably, we talk a lot about capital gaps, but we don't talk as much about capability gaps. And I think, startups see this all the time in terms of growing pains, but sometimes the expertise that's needed when you are in, basic and applied research is slightly different than what you might need as an entity when you are really trying to get up into the scale up mode, right? In terms of working with teams that have experience managing large industrial complexes and facilities. So I would say thinking a lot about workforce development and the deep bench that you want to assemble as you hit scale up mode is critically important. So talking about capabilities in addition to capital is probably one gap that I've seen. And then another, it's not necessarily a gap, but it's a piece of advice, as you mentioned to your first point, is really taking advantage of everything that Bill and Ira and the CHIPS Act have been able to provide. I think we have, Lisa mentioned this at the beginning as well, but there's an unprecedented amount of government support, to enable climate tech, clean energy tech, however you want to describe it. And so I think taking advantage of funding opportunities and financial assistance programs, but there's also a lot of technical assistance programs that are out there. Thinking about new financial mechanisms like transferable tax equity is extremely compelling as well for earlier stage companies. So those would probably be the two that I'm thinking of, but there are many more, and definitely a subject to we can't cover everything in 60 minutes here. But thank you for the question.
Awesome. Thank you so much, Campbell. Gabriel, over to you.
I think you should be able to see my screen. Is that right? Great. All right. Excuse me. So I figured I would start with a little intro about us, which is Elemental Accelerator. And as you can see here, we're a nonprofit investor focused on scaling climate technologies with deep community impact. And I think worth noting, we're a bit different, obviously, from the Loan Program Office, which is awesome. And it was so cool seeing your slide with how much you've done over the years. It's unbelievable. Elemental is a lot smaller than that. But we've been around since about 2009, and we've invested more than 160 companies. We invest globally, have invested in the US, in Europe, in Africa, in India, and APAC. So really pleased to be able to support entrepreneurs across a lot of different stages of the journey. And you've mentioned a couple of times, we're talking a lot to earlier stage folks here. We do tend to see a lot of folks in the sort of pre-seed, seed, sometimes Series A, sometimes a little bit later stage. This year we had two tracks. One of them was a $350,000 investment, along with a lot of coaching to support companies as they prepare to scale. The other track is the project track. And you started this with some folk music, Alex, very well done. But a lot of those project track applicants are companies applying with a first of a kind or a riskier project, something that needs a bit of catalytic capital, a little lean in on something that may be taking a product from version 1 to version 2, or moving from one geography to another, or expanding into something bigger. Now, through all this, we've seen a lot of different companies, a lot of different projects, and we've seen a lot of the challenges. And Lisa, you did such a great job of capturing sort of those challenges. And you mentioned the $150 billion scale gap. And Viv, if you don't mind dropping in a link, but we dropped a white paper a little while back in which, along with Boston Consulting Group, we looked at the industry and trying to figure out, what are the challenges, what are the gaps? And what we identified was that for many companies, they do that first project, as you mentioned, Campbell, with your talking about sort of you get the first one in the ground, and then how do you get to the nth version of that project? And what we found was oftentimes companies need to get to second and third and 10th project deployments to attract that later stage financing that Lisa so well explained in the first presentation. Often that isn't a lot of money in relative terms, but what we found was that the scale gap collectively was something like $150 billion across the industry. And it's just sort of a big piece of the missing puzzle, which is we did a thing, we proved we could do it once. We need to prove we can do it again and again and again, to the point where infra or equity, or a private equity rather, or other groups will look at it from a funding perspective, where you've de-risked it to a point where you can get there. So with that, I will move on to one piece of the solution that we've created. So we worked with Wilson Sonsini to create something called the D-Safe. And the D-Safe is modeled after the SAFE, which many of you are probably familiar with. Y Combinator developed that a number of years ago, and it has become a standard in the industry. The D-Safe takes a slightly different approach, which is that it's focused really on the project development costs. And so if you think about project development, you might have a variety of different things that fall under development costs that can be high risk and, as a result, rather expensive. And even if the company has developed a very established process, they know what they're doing, each project is unique, right? So if you take on a new site, you have unique things that come with that unique site. And I'll kind of give you a little talk through of what that might look like. If you imagine a charging infrastructure company who's going to put chargers in the ground, for example, for trucking, they first identify a site, and that site looks great on paper, but you don't necessarily know what you don't know. So with pre-project work, you might have finding an EPC who can do a lot of the work for you. You have to get some permits. You maybe have to figure out interconnection. There may be some community engagement that you need to do, reaching out to the local organizations that you'd work with or who could potentially be opposed to you. Either way, there's a lot of work that needs to be done before any steel goes in the ground. And if you're using traditional venture dollars, you might look at that and say, wow, that's really expensive. You're talking 8, 12, 14 months of timeline where, frankly, really expensive money, as Lisa explained earlier, is going to be used to do this sort of nebulous, hand-wavy stuff of, again, permitting, interconnection, EPCs, et cetera, that gets really hard to do. And often, this isn't necessarily a lot of money. So for a charger install like this, for example, it might be something like $1 million, $2 million to hold that site and to do all that work that needs to come with it. And so the development safe, the D-Safe, is designed to take away some of the risks there. And with that, I'll touch on some of the key features. So much like a SAFE, this is something where funding is directed to the parent company, meaning if you're the company developing that site, we are putting that money into you in the form of a SAFE. However, it gives it, or rather, before I get to the however, it de-risks the investment, as it says here. So you can essentially invest in the company, have this money, but specifically to go after the development costs. Now, the cool thing about it is it has a redemption clause so that it can operate like a loan and get paid back at the company's option. So the company goes through the process. They do all that development work, 10 months, 12 months, whatever it is later. They say, okay, it's done, we're paying you back. And Elemental is a catalytic investor. So in our case, we can take a potentially lower rate of return. You could also apply a market return on this. However, at the end of that development process, the company can say, you know what, we want to pay this back. And in our perspective, that's great, because now you can go and do it again, right? You're going to have to build site 3, site 4, site N, whatever it is. We would love to support you on that. So pay back that note, give it back to us, and we'll put it back in, and you can go do it again. That's part of the mechanism. On the other hand, and this is where the risk part comes in, reducing risk for the investor, sometimes projects don't work out. So you took a stake on this site, and you went into it, and you thought, we got it. You got the, some piece of it done. The EPC hired, and they found there's actually this total deal breaker thing. This project is not moving forward. So as an investor, that risk suddenly became a real problem. However, the cool thing about this being AD safe is that you can convert that into equity into the parent company. So we still like you. We believe in you as a company. We're so excited to continue supporting you. Convert it to equity, off we go. Or in the company's case, they succeeded on the project, turn it back into a loan, pay it back, and move on to the next project. So the things about it that tend to work really well, it's speedy. For the most part, people know what a safe is, and this is modeled on a safe. So there's not a lot of back and forth around legal and financial, and like, what is this agreement we're coming to? It's more like, oh, it's a safe, but with some tweaks. Now we just have to work out on the edges, the details there. Tends to be pretty founder friendly because you can have aligned incentives. And one of the things we found in particular is that pairing it with a development support agreement, which is essentially an agreement about how we're going to work together on this specific project, means you can come pretty quickly to an understanding of what the milestones are, how to know whether we got to where we want to go, which means your incentives are aligned, you know when you've achieved the things you needed to achieve, and whether it's time to convert it either to safe or back into debt and payback. And then finally, it tends to be very flexible. The result of that is that you can reduce those risks that investors often don't want to take on development costs, but you can do so in a way that incentivizes the startup to get moving. So we have now, at this point, I think done 8 D-Safes working across our portfolio and have found quite a few different sort of examples of where it has worked really well. We've had a couple companies say, yeah, this was literally the difference between making this deal go and not go, simply because suddenly we had capital that was willing to take on the risk of the development side of things and gave us the option at the end of it to say where it goes next. So with that, I'll wrap, and I wanted to leave open for questions. I know, Alex, you've got one, and then also happy to take it from others.
Awesome. Thank you so much, Gabriel. I mean, first of all, thank you as well just to the Elemental team for being such big thought leaders in the climate tech space. It's really like an innovative model across the board, and especially as we start talking about the D-Safe. So question for you is, how do you want the D-Safe to be used in the future? And if you could wave a magic wand, what would that look like?
Well, that's a great question. You've got, safes, which were a thing that YC created and that are now ubiquitous. Would it be awesome if this happened the same way? Yeah, it'd be great. But I think more to the point, we didn't do it so that we had a sort of stake on everybody using a thing that we had a hand in creating, but more there's this gap and it needs to be solved. And I think Lisa, again, did such a great job of laying out what the gap is. And the point of the D-Safe is to help reduce that gap, to create an opportunity for companies and investors to align around getting development done so we can hurry up and build projects 2, 3, 5, 25, whatever it is, off to the races to the point where other funding steps in and says, wow, you've really de-risked this. We're good to go now. We can give you lower cost capital. We can take what we see as less risk and move it forward. So I think to me, the win is the D-Safe unlocks a whole bunch of new projects that unlock themselves, a whole bunch of new funding, which speeds up the transition that we all know needs to happen. So yeah, I guess that would be my hoped for outcome.
Awesome. Thank you so much. So question to our panelists, what do you see in the state of the climate tech capital stack that excites you and then also concerns you, especially moving from 2024 into 2025?
I'm excited how much interest there is, just as a generalized statement. I mean, we've seen so many new funds spin up specifically focus on climate tech. And funds that are taking on the scale gap, funds that are taking on all sorts of different levels of the puzzle. And it feels like there is an increasing awareness of the various places that there are still gaps and the need to be innovative with the financing side. Lisa, again, did a great job on the different ones. For example, working with Fervo, we've been working with them on that project in Utah that you mentioned, and it is amazing to see what they're doing with Google, which is not a traditional VC in any sense. It's not a, they're a totally different entity. And I think that people are realizing we need to bring in non-traditional players. Another one is, I think, a growing awareness of different community players. So, for example, our work with Dimensional Energy, which has, featured a D-Safe, and we published a little bit about that, was working with the Seneca Nation in upstate New York. And so engaging the tribe there and really having them bought in and having their capital come to the table, but also their community. It was like, it feels like it's unlocked a lot of different pieces of the puzzle. So I think for me, those are a couple of the exciting points.
Awesome.
And I think just to layer on to what Gabriel so eloquently said, the role of strategics, I find really, really interesting here right now. And I think you're seeing companies providing in-kind services as well as capital in a manner that makes it easier to attract capital as well. So for instance, groups like Neighbors and Halliburton will provide access to their underlying services and capabilities, their rigs, their fields, and that can be just as valuable by then diminishing the amount of capital that you actually need to take on board.
Awesome. Campbell, any thoughts?
I guess, sure. I mean, I think there's so much to be excited about. I think first and foremost, the diversification of what climate looks like and what clean energy looks like. I mean, if we were to have this webinar 5, 10 years ago, the story would still be solar and wind, right? And now I think what we're seeing is there's all these really new, exciting, innovative technologies that are coming into play, and that they are unlocking so many new, interesting applications, which therefore, get supported by all these kind of creative and different commercial structures. So I would say that's one element of diversification. I suppose the other one is just all the different stakeholders who are now able to come to the table and have a voice in this energy transformation. So, this is, certainly there is a lot of federal support, as I mentioned, with Bill and IRA, but I think one thing that perhaps I missed in my speaking portion was how much sort of state and local elected officials are having in supporting clean energy, and how there's such a meaningful impact right now in terms of jobs in communities. And I think these sort of tangible facets to clean energy, and seeing projects actually getting built up is really exciting as well. So there's a lot to be excited about, but I think diversification is sort of a key term that I think about in 2024 and 2025.
Totally agree. I mean, over at New Lab, we're doing a lot of work down in Louisiana right now to set up some piloting opportunities for companies in carbon management as well as hydrogen. And it's been incredible to see the amount of support and just resources and convening that, the government as well as the economic development groups have been bringing to the table. So shout out to GNO Inc. as well as Fuel for that. A question came in from Jacob Frost. And the question is, as shared project / infra capital is not open to binary risk when looking at folk financing, also comment when we say folk, that's first of a kind, just to I guess, talk about some jargon. But there's been innovations in aggregating various, but has there been innovations in aggregating various folk projects from distinct entities into a portfolio that is then invested in by multiple different infra investors? So basically kind of like a value chain linking across a bunch of different companies.
I'm happy to take that one first, and then would be thrilled for my fellow panelists to hop in. When I'm reading that question or hearing that question, I think in many ways about sort of a hub-based approach. And so one example would be thinking about DOE's H2 Hubs initiative. So DOE was awarded $8 billion in funding for the establishment of regional clean hydrogen hubs. And basically 7 were announced. They're sort of receiving about $1 billion or so each, give or take. And those are basically a way to co-locate a variety of different clean hydrogen producers, so several different project types, as well as off-takers and midstream, meaning sort of transport, storage, infrastructure players all into one. So you could see a region, one just got announced over in California, it's called the Arches Project, or there's one that's in the Pacific Northwest as well. They do kind of vary a little bit, where they're not all necessarily in one state, they might be in a few different states, but they're certainly co-located benefits, right, to doing that. So it's not necessarily a formalized portfolio, but you'll see different investors kind of coming in and supporting these hubs, because again, hubs are sort of a 50% cost share model. And I think the $8 billion hubs is likely going to lead to 50 billion or so of private sector crowd in. So it's a portfolio, but in a less robust term, less formalized term than I think maybe is being asked in the question. But I certainly think that there's benefits to thinking about consortium, and particularly thinking about bringing together supply and demand.
Yeah, we have a big hub that we work with called H to the Future over in Louisiana as well.
I think it's, we can move on to the next question.
Go for it, Lisa. Go for it.
I think it's a super interesting structure, and one that we've been noodling on a little bit. I think the challenge is that that's a lot of concentration of risk. And so in terms of who would invest in something like that, I think that actually gets back to the strategics question a little bit. You'd likely want some some group of people who are also interested in the success of these projects for a strategic outcome as well, because the risk profile is quite concentrated. In a certain sense, it's not dissimilar from what a growth stage VC might be doing as well, if that's the particular development stage that they're targeting. But I think that there's an interesting question in particular as we see more climate tech companies reach that scale of whether you could create a sufficiently diversified portfolio that cuts across what we know is a very multi-sector space to create a little bit more balance, and that also then ends up taking a different financing approach that accounts for some of the risks as well, by, say, providing the option to also benefit at the top co level and not just at the folk project level, or that provides access to follow-on projects. So finding ways to blend not just across projects, but across almost tranches of capital within corporate structures is another way to think about it.
Alex, I might just add one last thought on that, which is you're kind of describing almost like a double syndicate, where it's a syndicate of projects and a syndicate of investors. And I would say that a different way to look at the D-SAFE, sorry, is in some ways it is kind of taking that syndicated project approach minus the syndicated investor part, which is to say, I can say I want to bet on your company, and there are a whole variety of projects that we could look at. And so for the D-SAFE, I could look at this project and that project and that project and kind of hedge my risk across the projects, knowing that I can convert to equity in the company if this project goes sideways, but this one might actually succeed, pay back, and off we go to that one over there. So it's not what you're asking quite. However, I do think it's an interesting approach in the sense that you can take on a variety of projects which do have different characteristics, but working with the same topco, the same parent company.
Awesome. Super interesting. This next question, I think we have time for one more question after this, comes from Franklin Chase. He says, thinking about diversifying even further beyond traditional VC funding than has been discussed here. Pretty niche case, but I work for a business owned by a Native American tribe, Seneca Nation High Elemental. Companies like ours cannot afford to innovate due to inaccessibility of high-risk capital, given the relationship between traditional ownership structures of venture-level investment and historic injustices experienced by tribes. What are some more innovative investment vehicles for companies who, for some good reasons, are wary of giving up equity?
I think it's an incredible question, and also gets to an element of the capital stack that we didn't talk about, that there actually may be, from a company standpoint, a preference towards one flavor of capital or another, and it's really a two-sided decision. I think I'm going to provide an answer that's not particularly detailed or articulate in the hopes that maybe Campbell can fill in, but in particular, on the topic of taking advantage of programs under Bill and IJA, there are a fair amount of funds that are particularly tailored or earmarked towards environmental justice communities, energy communities, disadvantaged communities. And so I think mapping out, and there are resources, in fact, that we can follow up on after this call that aggregate those particular programs. And so that's one potential source that I might look to just right off the bat.
Awesome.
Yeah, happy to follow up. That is certainly, that's been a huge priority for the Biden-Harris administration. And, similarly, would just share that with an LPO in specific, right, we do have a program that's dedicated towards working, with projects that are either operated with tribal organizations and tribal management, or that are on tribal land. So happy to give more detail to the LPO use case, but can also point folks towards, our community jobs and justice and environmental justice and equity teams as well. And there's certainly a lot of non-traditional financing that's also available that are outside of sort of the traditional VC model that we can speak to.
Awesome. Okay, quick answer to a question. Will the webinar replay be available? Yes, we will be sharing this. This is going to be public, free, and open. Last question is from Alice from Again, which is a green chemical manufacturing scale-up. I have a general question regarding project development and cost overrun risks and how to hedge them. As you have explained and shown, climate tech is booming, but this also means that contractors are being overbooked and projects experience significant delays. Do you have any views on this and how to bridge the consequent financial risk?
it's real. It's definitely real. There are gaps all over the place on that. And I think that's one of the things that is exciting, is looking at some of the apprenticeship programs that are springing up, some of the work that actually some of our companies are doing with universities and colleges, realizing that we need more talent. That's not quite answering your question around how you hedge on that risk, but because the reality is that we do have a lack. We need more people in all of these different trades that are out there building things and getting things off the ground. Campbell or Lisa, you have anything to add on that?
I think in terms of structuring your contracts to account for that to account for those delays, and in particular the cost implications of them, trying not to benchmark to a particular cost point, but within a range based on external circumstances is one lever. And then I think the other is, frankly, it gets back to the planning point that that's now no longer outside of the norm. It is the norm. And so I think we have to recalibrate how we think about project scale up, and potentially, again, modularizing and trying to pull forward particular pieces, since getting a full large scale project deployed is just a gargantuan task.
Yeah. The assumption is
maybe just go ahead, Alex.
Yeah, the assumption is that it's always going to be slower, more expensive, and take more time. Let's see. I think that we're ready to wrap. Campbell, what were you going to say before we wrap?
I was just going to say that I think that it's imbued, right? It is a problem. Certainly, I think we're looking at different contracting structures, as Lisa mentioned, to hedge against that. But I think there's also something of learning by doing, right? And that, this is certainly an inevitability for a first of a kind project, but as we can continue to deploy like new projects, right, and rinsing and repeating the models, we should hopefully be able to get those delay times, those run times down, and de-risk it, because that's another element of risk that we haven't talked about too much, where project delays in addition to cancellations.
Awesome. Well, thank you, everyone. Thank you, Campbell. Thank you, Lisa. Thank you, Gabriel, for joining us. And yeah, this webinar will be available. We'll send it to you after. And thank you for spending some time with us today. Bye, everyone.
Thanks, everyone.